Hello, everyone, and welcome back. Today, we are deep diving into a stock that has been making waves in the Indian engineering, research, and development space, Cyient Ltd. While many investors flock to standard IT services, the real growth is happening in specialized engineering. Cyient, formerly known as Infotech Enterprises, has transformed itself into a global leader providing solutions across aerospace, defense, and connectivity. But the big question on every investor's mind is, after the recent rally, does this stock still have multi-bagger potential, or has the ship already sailed? In this 13-minute analysis, we will break down their business model, financial health, and the technological tailwinds that could propel this stock to new heights. Let's get started.
To understand Cyient, you must understand where their money comes from. Unlike traditional IT companies that focus on software maintenance, Cyient thrives on design-led manufacturing and specialized engineering. Their revenue is diversified across three main pillars: transportation, which includes aerospace and rail; connectivity, covering telecom and 5G; and new economies, focusing on sustainability and medical technologies. In FY24, the Digital Engineering and Technology, or DET, segment contributed the lion's share of their revenue. This diversification is their biggest strength, protecting them from a slowdown in any single industry. They aren't just coding, they are helping design the engines of the future and the chips that power our devices.
Now let's look at the hard numbers. Financial discipline is what separates a good company from a great investment. Over the last few years, Cyient has shown impressive resilience. For FY24, the company reported a consolidated revenue of approximately 7,147 crores, representing a significant year-over-year growth. More importantly, their EBITDA margins have stabilized around the 14 to 16% mark, despite global inflationary pressures. The net profit, or PAT, has also seen a healthy trajectory. Investors should particularly note the order intake, which has been consistently strong, providing high visibility for future earnings. They have a healthy debt-to-equity ratio, ensuring that they aren't over-leveraged while pursuing aggressive growth and acquisitions. The crown jewel of Cyient's portfolio is undoubtedly its aerospace and defense vertical. They work with global giants like Pratt & Whitney and Boeing. As the global aviation industry recovers and defense spending increases worldwide, Cyient is perfectly positioned. They provide end-to-end engineering solutions, from engine design to aftermarket services. This isn't just about selling parts, it's about deep-rooted engineering partnerships that last decades. With the Indian government's Atmanirbhar Bharat initiative pushing for local defense manufacturing, Cyient's domestic subsidiary, Cyient DLM, is also gaining massive traction. This dual-engine growth, global aviation recovery, and domestic defense is a primary reason why analysts are bullish. In the modern era, engineering without digital integration is obsolete. Cyient is pivoting heavily towards intelligent engineering. They are integrating artificial intelligence, machine learning, and industrial IoT into their core offerings. This shift allows them to command higher billing rates compared to traditional services. Whether it's predictive maintenance for factories or designing smarter chips for the semiconductor industry, Cyient is at the forefront. Their investment in AI isn't just a buzzword, it's being applied to optimize grid management for utility companies and enhance connectivity for telecom providers. This digital pivot is crucial for margin expansion in the coming quarters.
How does Cyient stack up against its peers? When compared to industry leaders like Tata Elxsi or L&T Technology Services, LTTS, Cyient has often traded at a valuation discount. While Tata Elxsi often commands a PE ratio of over 50x, Cyient has historically traded in the 25x to 35x range. This valuation gap is what attracts value investors. However, it's important to ask, why the discount? Historically, Cyient had lower margins than its peers, but as they exit low-margin businesses and focus on high-growth debt segments, this gap is narrowing. If Cyient can match the margin profile of its larger competitors, we could see a significant re-rating of the stock price, leading to multi-fold returns.
No investment is without risk. For Cyient, the biggest headwind is a global macroeconomic slowdown. Since a large portion of their revenue comes from the US and Europe, any recessionary pressure in these regions can lead to deferred engineering spends. Secondly, the war for talent in the engineering space is intense. High attrition rates can lead to increased employee costs, putting pressure on those hard-earned margins. Additionally, while their diversification is a strength, it also means they face competition from specialized players in every niche, from aerospace-focused firms to digital-first boutiques. Investors must keep a close eye on the quarterly attrition numbers and the management's guidance on vertical-specific growth. In conclusion, Cyient is a compelling story of transformation. They have evolved from a services firm into a design-led engineering powerhouse. With a solid presence in aerospace, a burgeoning defense business through Cyient DLM, and a clear AI roadmap, the fundamentals look strong. The stock is no longer the cheap bargain it was 2 years ago, but compared to its peers, there is still room for valuation expansion. For a long-term investor, Cyient offers a blend of stability and high growth potential. Is it a multi-bagger? If they execute their 2025 vision and maintain margin discipline, it very well could be. As always, consult your financial advisor before investing. What are your thoughts on Cyient? Let us know in the comments below.